how investors should look at all the news flow and approach the market from here. We've got none other than Amish Shah, the head of India research at BofA Global Research, joining in the show right now. Amish, hi, morning. Great to have you today on ET Now. Thank you so much for your time. Amish, I'm just looking at your last note because that was built on a prolonged conflict scenario. Now with the headline reversal, and I know you were talking about an 8.5% Nifty EPS growth call earlier, but now with the news flow and this ceasefire extension, does that sort of change your base case immediately, or are you going to wait for this 2 weeks time period to play out before taking a decisive call?
Morning, Aisha. No, so obviously, look, there are various scenarios that we've drawn out in the note. We will go back to the base case, which is of lower crude, better GDP growth, lower inflation, possibly no need to hike rates. And what we've also seen historically is that during the conflict, valuation multiples for markets trade between long-term average and -1 standard deviation, which is a trajectory that we were on to. We had gone to slightly lower than the long-term average valuations. But once the conflict ends, historically, it has always led to valuations going higher than long-term average and in between +1 standard deviation. So I think that is a trajectory that we will possibly go to now. Remember that we had not cut our price target for Nifty as a year end. That we are continuing to call at about 26,200. Which from current levels is still about 13% upside. So I guess we will play for that upside now.
Amish, is crude the sort of hinge variable? And let's talk about not just this 15% respite that we've seen overnight, but even the $100 per barrel kind of levels. What kind of estimates are you working with when it comes to crude right now?
So Aisha, you are right. So crude, currency, interest rates, and commodities. I think these are the 4 key variables, and they are all interconnected. So as and when the crude was going up, you also had a commodity spike because aluminum obviously was in short supply and got disrupted from Middle East and so on and so forth. I think all of these variables will change. Currently, what we are working with is $92.5 of crude as an average for the whole of this calendar. Obviously, 3 months have passed, and hopefully crude rolls down further. But as of now, we are working with 92.5.
Amish, how do you look at the second order impact? Because we haven't seen that happening, or pushing through the P&L of many of the companies who are dependent on crude or crude derivatives. Is there going to be a significant impact to the earnings and margins in the first half at least?
Yes, so for the March quarter and for the June quarter results, we do think that there will be impact because some things had just become short in supply, and the ones which were available, companies have tried to pass on some bit of commodity price pressures. Some they have taken it on their own margins. So we do think that, obviously, since the conflict started end of February, March and April will have some impact. So some impact in March quarter, and that rolls over a little bit into June quarter as well. But thereafter, hopefully, if the ceasefire translates into an actual culmination of war, then we do think that from the second half of the calendar, earnings growth trajectory could start looking very promising.
Hi, Amish. This is Harsh joining the conversation. You downgraded certain interest rate sensitives. Give us the rationale for that. Does that still hold?
So Harsh, the interest rate hike assumption was on the back of commodity pressures and that leading to inflation and RBI possibly having to hike rates in order to control that inflation. Clearly, if the inflation problem was and is short-lived, if the war comes to an end, the need for the rate hikes goes away. And then as a result of that, rate sensitives that we were worried about are not something that we would worry about incrementally. So the rate sensitives that includes NBFCs, passenger vehicles, real estate, all of these sectors that that are disadvantaged when the rates go up, one could start looking at them favorably as well.
How do you look at consumption as a theme? Do you think that discretionary spends will come back, or will it take few more months before we see discretionary picking up further?
So on consumption, even before the conflict, we were of the view that anything that is a consumption basket of a well-off Indian was doing well, will continue to do well. So that includes things like autos, consumer durables, jewelry, travel and tourism, so on and so forth. But anything that is to do with the mass Indian consumer, which is about 76% of India, that we are of the view that they have seen massive leverage build up since COVID for a variety of reasons over a 5-6 year period. And over the last 18 months, government has been actually trying to solve that problem of their leverage by putting money into their pocket in the form of tax cuts, interest rate cuts, and by giving them subsidies. So I think markets are getting excited that the money being put by the government in their pocket, they will go and spend that money, and therefore mass consumption stocks should also do well. But that is not our view, because we are of the view that the money that the government has put in their pocket so far equates to $74 billion, but the leverage that they've taken is around $158 billion. So you will require another $74 billion or one more year of these benefits to continue, by which the leverage would have rolled off, and the mass consumption, we think, therefore will pick up in the next calendar year or 12 months away from now. So mass consumption, we think this year continues to underperform, and that includes categories like staples, retailers, footwear, apparels. So all of these categories we think underperforms, and the well-off consumption discretionary categories outperforms.
Is monsoon in all this? Is there going to be an issue with respect to the kind of weather predictions which are coming through from various agencies?
So that we have still not budgeted as a part of our base case. I guess we are still discussing how the summer pans out. So monsoon is a little too early, and maybe these patterns or forecasts can change. So as of now, weather, to answer your question, specifically monsoons, is not a part of our estimates that we are talking about.
Amish, the other thing is, how is it that you go back to the drawing board and try and, build a portfolio? I mean, I know all of it is interlinked, and perhaps it's only consumption, and that too the supply chain and the crude price sensitivity or RMC sensitivity plays out. But is there any space or sector right now in the market which you would say is a little bit isolated from the rest of the world? And could pharma be that opportunity, and especially the entire GLP-1 trade?
Absolutely, Aisha. So there is in the report that you speak about, there is a list of subsectors and stocks that we had highlighted, that war or no war, these are stocks and sectors that we think will continue to do well. Amongst them were, let's say, power utilities and the entire ecosystem to the power value chain. So it includes transformers, cables, power generators, power transmission companies. So all of that, any which ways India was trying to ramp up in terms of capacity additions for data centers and the growing power needs of India. And over and above that, because of this conflict, we are of the view that government will double down on this capex from an energy security perspective. So I think that is an entire pack that will continue to do well, even if the conflict were to continue. And the second one, as you mentioned, is pharma. Clearly, inelastic sector, large part of the pharma sales is to the rest of the world in US and Europe. And those are the geographies that are not impacted. They are, in fact, of beneficiaries from the rupee depreciation because of the conflict. So pharma, hospitals, all of that falls in that bucket. And then you also have telecom, as one of the other opportunities, which we think will continue to do well. And that aside, I would say that even before the conflict, you would agree that most guests that would have been coming on your channel would have been arguing that the financial sector is actually quite cheap. It's a value sector, and it has only gone cheaper during the conflict. So financials is another pack that we used to like and we continue to like in these valuations.
Oh, yeah, absolutely. For reasons very much outside the conflict, though it was a conflict of a different nature. But anyway, other than that, Amish, I also wanted your opinion on IT and whether valuations there are getting right. And more importantly, now after the massive correction that's played out in IT and perhaps some of the AI fear is already in the price, is valuation the right metric to even look at IT right now? Because then that becomes only a tactical trade. Or do you wait for the numbers to actually turn the corner and the commentary as well, perhaps?
So Aisha, IT in fact is a sector that we thought will outperform till the time the conflict goes on, because conflict was expected to be short-lived, so there was no impact. Even if you believe in the AI disruption, there was no impact on earnings coming in the next 1 or 2 months. But IT was a beneficiary of the rupee depreciation that was happening during the conflict. So it was a good sector to hide, while the conflict was going on. But meaning if we assume that the conflict is coming to an end, then I would like to believe that IT will underperform. Because markets will want to move into the beta trades, the rate sensitives that we were discussing, banks, etc., that has fallen quite meaningfully. IT does not make the cut. And over and above that, from a medium to long-term perspective, we are, as a house, we do believe that AI disruption is for real. And even if we believe that there will be more opportunities or more growth on the back of enterprise-level AI implementation, we think that there will be first a growth come off, and then there will be growth benefits on the back of AI-related plays. So we do think that IT as a sector can underperform, can possibly get a little more cheaper. And from a full year perspective, we continue to have an underweight on IT space. Obviously, there are a couple of bottom-up stocks within IT that my IT analyst prefers, but by and large, we are underweight IT.
The other thing, Amish, I wanted to address was also this massive FII, FPI outflow, right? For the market to recover, and I know this excitement and knee-jerk that you're seeing today on the screen is also going to settle down eventually, but the India versus EM call, does that change now with this ceasefire extension and the West Asia situation sort of at least seeming to be settling down?
So Aisha, it does not, because during the conflict, all sorts of Asian countries had got impacted, and similarly, China, Korea, Taiwan, they are all down as markets when India was falling as well. But if you go back, the main issue that investors had, if you are an EM investor, was that the rest of the emerging markets, which is China, Korea, and Taiwan, they are predominantly linked to the AI theme. And on the back of the AI capex by the hyperscalers globally, these are companies that are going to see a massive growth. So take, for instance, in Korea, the expectation is for 180% earnings growth this calendar year. In Taiwan, the expectation is 35% earnings growth. China is expected to give you 14-15% earnings growth. And all of these are markets which are much cheaper than India. So Korea is at 7p multiple, Taiwan is at 18, and China is at 11.5. So the main worry that the EM investor had is that India does not offer us AI-linked higher growth, but yet is an expensive market at 20 plus P multiples. I think that equation does not change. So while we do believe that India will offer 13 to 15% upside, we think that the other emerging markets will give even better upside. And as a result, India will continue to underperform emerging markets as far as this calendar year is concerned.
I get that point, Amish, that we were looked at as the anti-AI or anti-semicon trade. But remember, before the war, that was the biggest headline, right? When will that trade in the US reverse, and when will that trickle down to the rest of the world too?
So you're absolutely right, Aisha. But at least our global house views are that AI capex is not yet peaking in this calendar. So if you recollect, last calendar, all the hyperscalers globally implemented $450 billion of capex on AI. This year is expected to be anywhere between $650 to $700 billion. next year is expected to be $1 trillion. So till the time the capex of AI from hyperscalers continue to accelerate, the trade on Korea, Taiwan is not yet over. But you are absolutely right. The day when somebody takes a call that there is no upside left from $1 trillion further, then possibly that's a reversal of the EM story, and that flows will rotate back to India.
See a trade happening with respect to data centers and the kind of expansion that's expected in India going forward. I'm talking of a medium-term, scenario here where there could be chances where the hyperscalers may move some of the facilities from Middle East to India, being much more stable and resilient.
Possibly, that is definitely an alternative. But even otherwise, you would recollect that India currently has only 3.5 gigawatts of data center capacity, and that we were planning to take it to 10 gigawatts. That itself is enough and more growth. In fact, there are supply issues or supply constraints as far as cables and transformers and all sorts of equipment that goes into a data center. Any which ways, we were of the view that these companies will have pricing power and a very solid growth, and that narrative continues. Middle East capex of data center possibly moving to India is going to be a upside potential or an option value over and above that.
Amish, with regard to energy, that was the other big theme. Everyone wanted to be Atmanirbhar with regard to energy. Does that at all change, in your opinion, given the developments of the last few hours?
The government has not made any policy announcement on that yet, but our personal views or our house views are that energy security is something that the governments will have to focus on. In fact, in a recent report that we put out, we have actually done a bottom-up math on where is the possibility to do more of energy security. So let's say, what can you translate? What can you move away from crude and gas in favor of electricity and biofuels is the math that we had done. And the conclusion that we reached to is that over the next 7-8 years, there's a possibility to add another 160 gigawatts of power capacity that can replace a large part of crude and gas consumption that we have in terms of cooking, industrial gases, and so on and so forth. And if you do believe in that 160 gigawatt of capacity additional, then that could add $200 billion of capex over the next 5 years, over and above the capex that the government was already budgeting for. And as a result of that, we were bullish on the power sector ecosystem. And similar to your question on data centers, if the government talks about energy security, there could be an upside of $200 billion as an option value over and above our bullish call.
And Amish, within the financials basket, the fact that you're probably not penciling in rate hikes now, do NBFCs now look more attractive versus banks, or are banks still the go-to? That's the first part. Second, within the broader financials ecosystem, where else are you finding better value versus maybe some of the lenders?
So in terms of our pecking order, I would still say that the large 4 private banks, followed by SOE banks or PSU banks, and then NBFCs is the pecking order. This is putting into context the risk, growth, and valuations, all these 3 parameters into the model, because from an NBFC perspective, a lot of them are exposed to MFI, MSMEs, commercial vehicles, which one could argue is still not the best portfolio to have versus banks. We think that the asset quality is going to be quite good. Their NIMs are going to be now settling down, and there is a reversal, meaning, or the loan growth is going to accelerate, and the valuations have gone very cheap. Most of the large 4 private banks are trading at 1.5, 1.6 price to book. SOE banks are trading at 1.1 or lower than that price to book, which is actually very, very attractive. So putting into the framework of growth, risk, and valuations, we still prefer large private banks, PSU banks, and then the NBFCs.
Well, what a commentary coming in from Donald Trump. Iran can start the reconstruction process. That's what he's tweeted on Truth Social. There will be lots of positive action. Big money will be made. That's the US president talking about the ceasefire extension with Iran. He's saying it's a big day for world peace. Iran wants it to happen. They've had enough. Likewise, so has everyone else. The United States of America will be helping with the traffic buildup in the Strait. So I guess, Amish, that really sort of settles down everything. It seems like it's almost a truce now, going by, Trump's emotion.
Absolutely, and that's welcome news for all of us.
Yeah, absolutely. All that uncertainty, of course, one has to see how Iran is going to actually respond to that. But just going by the commentary, it seems like he's all in for a truce. He's saying that this will be a double-sided ceasefire. The reason for doing so is that we have already met and exceeded all military objectives and are very far along with a definitive agreement concerning long-term peace with Iran and peace in the Middle East. So, while it's not a done deal right now, but the intent, at least from the US side, from America's side, seems to be very, very clear.
Amish, do you see a trade here with respect to the entire reconstruction of the Middle East and maybe Iran going forward, and the opportunity that it may throw for many Indian companies?
Absolutely. Again, that is something that we have written out in a separate note. In fact, we have provided the quantum of that opportunity. We believe that that could be a $20 to $40 billion opportunity for Indian EPC firms. And absolutely, that's a positive news for these companies.
Amish, I wonder, within that EPC kind of ecosystem, cables and wires, how best do you play it?
Meaning, I think the way to think about it is that within the capex overall basket, there are plenty of subsectors, like there is roads, railways, waterways, power, and so on and so forth. So within that, I would say that we would continue to avoid a vast majority of capex, but I would focus on looking at favorably defense, shipbuilding, cables, transformers, and the power generators and transmitters. So those 4 or 5 subsectors of capex is what we prefer. The rest we think will underperform in comparison to these 5 favorable ones.
Okay, Amish, great to have you on a day like today. And I'm glad that you could join in. You've really turned out to be the lucky mascot, haven't you?
Thank you. That's really heartening to hear.
Okay. Well,